What if I told you there's a company that holds the only government-certified small nuclear reactor design in America, and its stock just lost 80% of its value in 6 months?
That's the kind of setup that makes value investors lean forward and risk managers reach for the exit simultaneously.
Welcome to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, and today we're going deep on NuScale Power, ticker SMR, a company sitting at the intersection of the nuclear renaissance, the AI power crisis, and one of the most dramatic stock collapses we've covered. Lana Chen is here to run the numbers.
And there are a lot of numbers to run on this one, Hudson. Some of them are genuinely exciting. Some of them should keep you up at night.
Let's get into it. So NuScale Power is headquartered out in Tigard, Oregon, and they were founded back in 2007. At its core, this is a company that designs and builds small modular reactors, SMRs. Each module generates about 77 megawatts of electricity, and the whole idea is that you build these things in a factory, ship them to a site, and stack them together like building blocks.
And that's actually a pretty elegant solution to one of nuclear energy's biggest problems. Traditional nuclear plants take a decade to build, cost tens of billions, and are essentially one-of-a-kind construction projects. NuScale's pitch is standardization, factory-built modules that can be deployed faster and cheaper.
They make money, or plan to make money, through reactor module sales at roughly $40 million per unit, plus maintenance contracts running about $5 million annually per reactor, plus consulting services. They've got three key market segments they're targeting: utility-scale power generation, industrial process heat for things like petrochemicals, and the one everybody's talking about right now, data center power for AI infrastructure.
It's important to understand the sector context here. NuScale sits in the energy sector, specifically nuclear power and small modular reactors. The global SMR market is projected to hit about $38.6 billion in 2026, with over 100 different designs under development worldwide. So this is not a niche, it's becoming a major industrial category.
And the competitive landscape includes names like Oklo, TerraPower, which is backed by Bill Gates, GE Vernova's nuclear division, X-Energy, and Westinghouse. But NuScale has something none of them have yet:
The NRC certification. NuScale is the first and only small modular reactor designed to receive full design certification from the U.S. Nuclear Regulatory Commission. That is a multi-year, multi-hundred million dollar moat that every competitor has to cross before they can even begin commercial deployment.
And the timing couldn't be more relevant. We're in the middle of what some analysts are calling a nuclear renaissance, driven almost entirely by AI and data center electricity demand. Meta committed to 6.6 gigawatts of nuclear procurement back in January. Hyperscalers across the board are scrambling for baseload power. At the helm is John Lawrence Hopkins, who's been CEO since December 2012. That's 13 years now. Before NuScale, he spent over 2 decades at Fluor Corporation, one of the world's largest engineering and construction firms.
Hopkins rose through Fluor's ranks to head their government group and served as a corporate officer for over a decade. He holds a BBA in finance from UT Austin. His background is really in government contracting and large-scale project management, which is exactly what you'd want for a company that needs to navigate federal regulatory approvals and massive infrastructure builds.
He's also well-connected in policy circles, serves on the executive committee of the U.S. Chamber of Commerce. The market generally views him as a steady, experienced operator, though the execution stumbles we'll get into later have raised some questions.
All right, let's get into the financials. And I want to be upfront. This is where NuScale's story gets complicated. Starting with valuation, the stock is trading at $10.15 as of today, with a market cap of $3.45 billion. The 52-week range tells a dramatic story: a low of $9.66 and a high of $57.42. That's an 80% drawdown from the October highs.
57 to 10 in 6 months. That's brutal.
The PE ratio is negative 6.44, which is essentially meaningless for a pre-revenue company burning cash. The price-to-sales ratio sits at about 15 times trailing revenue, but even that metric is misleading given the revenue profile. The analyst consensus price target is $20.51, which implies over 100% upside, but with a range from $8 to $60 that tells you nobody really knows what this thing is worth.
What about the revenue picture?
Trailing 12-month revenue came in at $63.9 million. But here's the thing. Q4 2025 revenue collapsed to just $1.81 million. That's down from $8.2 million in Q3 and $8.1 in Q2. The year-over-year decline was about 15%.
$1.8 million in quarterly revenue for a $3.5 billion company. That's jarring.
Now, gross margin is actually quite strong at 67%, which makes sense because whatever revenue they do generate tends to be high-margin consulting and services work. But the operating margin, and this is where it gets truly eye-popping, is negative 984%.
How is that even possible?
When your revenue is under $2 million in a quarter but your operating expenses run into the hundreds of millions, that's what happens. General and administrative expenses surged over 3,000% in Q3 2025, largely because of a $495 million Enter1 partnership payment. The net loss for the year came in at $355.8 million.
Okay, so what about the balance sheet? How long can they sustain this?
This is actually the bright spot. NuScale has $1.3 billion in cash and equivalents as of year-end 2025. That liquidity increased 72% quarter over quarter thanks to that $507 million milestone payment from the Enter1 partnership. Total debt is 0, current ratio is 4.3, so the balance sheet itself is clean.
But the burn rate?
Free cash flow is negative $460 million annually. Operating cash flow is essentially the same, negative $460. Capital expenditure is minimal at $500,000, which makes sense because they're not building plants yet. They're in the design and certification phase. At current burn rates, that $1.3 billion gives them roughly 2.5 to 3 years of runway.
So not imminently running out of money, but the clock is ticking.
Exactly. And there's a significant dilution signal. The company is seeking shareholder approval to double authorized shares from 331 million to 662 million. That tells you management is preparing for significant capital raises ahead. Overall, NuScale's financial health is under pressure. The strategic position and balance sheet liquidity provide a foundation, but the massive cash burn, collapsing revenue, and dilution risk create serious near-term uncertainty.
So how are the analysts reading this situation?
The consensus rating is hold, with 12 analysts covering the stock. 5 have it at buy, 6 at hold, and 1 at sell. The average price target of 2051 implies about 102% upside from current levels, but that wide spread from $8 to $60 really underscores the uncertainty.
What are the notable calls?
Several firms maintain buy ratings based on the long-term nuclear renaissance thesis, but the near-term headwinds have made everyone cautious. The stock is down 80% from those October 2025 highs of $57, and that decline accelerated after the Q4 earnings miss and the lawsuit filings. The last earnings report was for Q4 2025. Revenue came in at $1.81 million, missing estimates. EPS was negative 80 cents, also a miss. The company didn't provide formal forward guidance but highlighted the Enter1 milestone payment and the improved liquidity position.
So the street is basically saying, great long-term story, terrifying near-term execution.
That's a fair summary.
All right, let me lay out the bull case because despite all the red flags, there are some genuinely powerful catalysts here. Number 1, the TVA Enter1 6-gigawatt SMR deployment program. This is the largest SMR program in U.S. history. If fully realized, it could power 4.5 million homes or 60 data centers across TVA's 7-state region.
That's a massive contract. The scale is almost hard to comprehend for a company this size.
Number 2, the NRC certification moat. Being the only certified SMR design under Part 52 removes the single biggest regulatory hurdle that every competitor still faces. That head start could be measured in years, not months.
And in the nuclear industry, years of regulatory lead time is enormously valuable.
Number 3, the AI and data center power demand explosion. Meta committed to 6.6 gigawatts of nuclear procurement in January 2026. Microsoft, Google, Amazon, they're all scrambling for reliable baseload power that can run 24/7. SMRs are a natural fit. And number 4, government funding support. The Department of Energy announced $800 million in cost-shared funding for SMR projects, and the U.S.-Japan Framework Agreement designated up to $25 billion for baseload energy programs.
Now let me walk through the bear case. And I want to be direct. These are serious risks. First, there are active securities fraud class action lawsuits filed in April 2026, alleging that NuScale misrepresented ENTRA1 Energy's capabilities and contract terms. Legal overhang like this can depress the stock for years, regardless of the underlying business trajectory.
That's a big one.
Second, the cash burn is staggering. $460 million annually with minimal revenue visibility, and the company signaling it wants to double its authorized share count tells you dilution is coming. Third, NuScale has a track record of execution issues. The Idaho National Laboratory project was scrapped in 2023, and the first commercial deployment has been pushed out to 2030 or beyond. Fourth, competition is intensifying globally. China's Linglong 1 SMR is targeting 2026 commercial operation, which would make it the first onshore commercial SMR in the world, not NuScale.
Let's see how NuScale stacks up against some comparable names. We looked at 3 peers: Oklo, GE Vernova, and Constellation Energy.
Oklo is the closest pure-play comparable. It's a pre-revenue advanced fission company backed by Sam Altman. They're developing the Aurora powerhouse using recycled nuclear fuel. Their NRC application is under review, so they're behind NuScale on the regulatory timeline, but have a potentially disruptive design. Neither company has meaningful revenue or positive earnings.
GE Vernova is a much bigger beast, profitable, diversified, with a PE around 52 and a PS of about 3.2. They have their BWRX 300 SMR under development through GE Hitachi, but nuclear is a relatively small piece of their overall business. Revenue growth of about 8%.
And Constellation Energy is the largest U.S. nuclear fleet operator, trading at about 38 times earnings, PS of 5.8 with 12% revenue growth. They benefit from the nuclear renaissance, but they're operating existing large reactors, not developing SMRs. So in terms of direct SMR comparables, NuScale is really in a category of its own among public companies.
On the option side, what are traders telling us?
The put-call ratio sits at 0.65, which actually leans bullish, more call buying than put buying. Implied volatility is elevated, sitting around the 72nd percentile. We're seeing significant call open interest clustering at the $15 and $20 strikes, and put open interest concentrated at 10 and 750. The overall read is that options traders are positioning for a potential recovery, but the elevated IV tells you the market expects big moves in either direction. This isn't a sleepy name.
Insider activity paints a less encouraging picture.
No insider buys in recent quarters, but 4 notable sales in Q1 2026. The COO Carl Fisher sold nearly 50,000 shares at $12.64, and CTO Jose Reyes sold about 26,000 shares at $12.22. When your chief operating officer and chief technology officer are both selling, that raises eyebrows, even if there could be legitimate planning reasons behind it.
So pulling it all together on risks, what should investors be watching most closely?
3 things above all else. First, the lawsuit trajectory. Those securities fraud cases could result in material settlements or restatements that would further pressure the stock and management credibility. Second, the cash runway. At current burn rates, they have roughly 2.5 years, but any delays in partnership monetization or additional contract cancellations could accelerate the need for dilutive capital raises. And third, the NTR1 relationship itself. This partnership represents nearly all of NuScale's forward revenue visibility, so any disruption there would be existential. On the catalyst side, watch for NRC activity around competitor applications, any new hyperscaler partnership announcements, and congressional action on nuclear energy funding.
So Lana, if you had to boil NuScale Power down to one paragraph, what would you say?
NuScale Power is a company with a genuinely unique strategic asset, the only NRC-certified small modular reactor sitting in the middle of what could be the biggest energy infrastructure build-out in a generation. But the gap between strategic potential and financial reality is enormous. The stock has already priced in a lot of the bad news, trading at $10 versus a $57 high, but the risks ahead are material. Lawsuits, cash burn, dilution, and an execution timeline measured in years, not quarters. The key metric to watch is quarterly cash burn relative to the liquidity runway. If that starts improving through new contracts, cost discipline, or partnership monetization, this could be a generational asymmetric bet. If it doesn't, the dilution math becomes very unfriendly.
We'll close with this one, Lana. Sheikh Ahmed Zaki Yamani, the former Saudi oil minister, once said, "The Stone Age didn't end because we ran out of stones. It ended because we found something better."
And that's really the question at the heart of NuScale's thesis. Has the energy world found something better in small modular reactors? The technology says yes. The financials say not yet.
That's going to do it for episode 48 of Charged Alpha, NuScale Power, ticker SMR. If you found this deep dive valuable, share it with someone who's following the nuclear space. We'll be back soon with another company breakdown. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. Data sourced from public filings, financial databases, and analyst reports. Accuracy is not guaranteed. Information is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.